in the place of markets and how they operate and how vulnerable they are?
Well, I would say it has weakened my faith, my confidence in the regulators and the rating agencies. They play an important part in the market. The market is not just individuals trading among themselves. We count on the Fed, the controller of the currency, the state banking regulators, to make sure that these institutions have adequate capital and that the assets that they're holding are the kind of quality that's appropriate for a large financial institution. And they fell down on the job on both of those. They ignored some of the assets that were in these special investment vehicles, so the banks didn't have enough capital. And obviously they allowed them to accumulate assets in the form of subprime and alt-A loans and the derivatives based on them, which they should never have done. So it has certainly shaken my confidence that we've got the right kind of supervisory mechanism in place for a market economy. We have to have a market economy. We certainly can't have the government making decisions on who shall get a mortgage and what little business will get a loan and what new startup will get startup money. So we have to depend on the market, but we also need to have good supervision. I don't know that we need new regulations, but we need better supervision than we've had in these past years.
Well, you know, a lot of people think that this deregulation began with Ronald Reagan, and they look to that as the beginning of the problem.
I don't. Certain aspects of deregulation have occurred over these last 25 years. I mean, for example, banks were able to move across state lines. I think that was basically a good thing. Banks were able to engage in a wider range of activities, not just traditional banking, but they could do what we now think of as investment banking, so that when Morgan Stanley was acquired or Goldman Sachs became a general bank, they were taking advantage of that kind of deregulation. But I think that actually strengthens the financial system. But it allowed risk-taking behavior that should have been limited by the supervisory mechanisms.
Universal banks are a good idea, then?
I think so.
Okay. Like Citigroup and JP Morgan and others. Europe.
Yes, I think so. I think that they allow them to do things, to provide capital in ways that would not otherwise be possible, and to diversify those risks. But excesses have occurred, and the supervisory authorities have been asleep at the switch.
So you're blaming the people who administered things rather than the laws and regulations that they had.
Well, I don't want to say this fellow or that gal should have been doing a better job, because it obviously came more from the top. There wasn't the care in directing the troops on the ground, the day-to-day supervisors, to be conscious. I mean, the fact that something like 40% of mortgages over the last few years were subprime or alt-A was not a secret. So the people at the top should have been looking at these macro numbers, at these aggregates, and saying to the supervisors, make sure that the banks have adequate capital if they're going to be having that kind of high-risk thing in their portfolio. Didn't do it.
What's your assessment, Mr. Bernanke and Mr. Geithner?
Well, they're both very talented people, and they are...
I'm talking about their decisions.
Yes, well, and they're being forced to make decisions on issues that none of us have ever had to think about before, and they're being forced to make them very quickly.
And the decisions they make, you think, what about?
Well, you took me through some of the key decisions, right. and I think that those were good decisions. I think, however, the Fed is putting itself in a position in which it is extending credit and a scale which makes me nervous.
Because
That isn't my idea of what the central bank should do. That if credit is to be extended, if risks are to be taken in the name of the taxpayers, that ought to come from the Treasury and the Congress rather than from the Federal Reserve.
The Federal Reserve does regulate interest rates, and you believe Mr. Greenspan made mistakes in terms of his handling of the question of interest rates and inflation, and should have foreseen this or contributed to the bubble?
Well, I think in the early part of the decade, he was very worried about the possibility that we would follow Japan into a situation in which we had very low interest rates, and yet inflation would be moving negative, and there'd be nothing that the Fed could do. And so rather than allow that to happen, he brought interest rates down very sharply and promised to keep them low for a number of years in order to stimulate the economy and to stimulate mortgage borrowing in particular. I think that, taken by itself, thinking about inflation and deflation, that was a good trade-off. It was sensible risk-taking. But where he failed was to take into account the risks of an asset bubble.
All right.
And that indeed is what happened. And that should have been seen by 2005 or 2004. We didn't have to wait until the bubble burst and all of this chaos resulted.
How long is it going to take us to get through this?
I don't think we know. I am worried that this could be a very deep and a very long downturn. It's very different from previous recessions, and it could last a long time.
5 years?
It's not clear what's going to take us out of this.
5 years, 10 years?
Oh, I certainly hope it's not that long, but it's hard to know what is going to turn this around and bring us out.
And what do you believe
it's not going to be...
Okay, but this is important. What do you believe could and what do you believe will not get us out of this?
Well, I think I come back to the issue that it's being driven by the fall in house prices. That's making people poorer and forcing them to think twice about spending. It's hurting the financial institutions. It's obviously stopped construction. Housing starts are down 40% from a year ago. So if we don't stop that rot, if we don't stop that decay, it's hard to see how this process stops. House prices overshot in the up direction by some 60%. What's to stop them from falling 60% below a normal level? Nothing if we don't find a way of stopping this process of default and foreclosure. So to me, that is key to stopping this.
And something that's not being done so far.
And something that's not being done. I think that the Treasury proposal will help to take some of the bad, impaired assets off the balance sheets. The Barney Frank, Chris Dodd legislation that passed earlier will help some of the people who have negative equity and are on the verge of defaulting, but none of that will stop this downward spiral in house prices that needs to be stopped. And so in addition to what has been done and what is proposed by the Treasury and by the Congress, I think we need to do a third piece.
And do we need to do it now? We can't wait till a new Congress and a new president.
I would be much happier, I'd be much more confident if we did it sooner. Because house prices, we just learned today that house prices fell almost 17% in the last 12 months. Well, if there are now 10 million homes with negative equity, and we wait another 12 months and house prices come down at that rate, that 10 million will be more than 20 million homes with negative equity. And the folks who now have mortgages that are 20% higher than the value of their house will find that they have